It's the biggest story in U.S. trading history right now. The S&P 500 on pace to break an all-time record on Wednesday, the longest-running bull market ever. And it seems really the only thing, or maybe the only person that can derail this market would be the Federal Reserve and Jerome Powell. And just moments ago, President Trump telling Reuters that he is, quote, not thrilled with the Fed or Powell for all the raising of rates that they've already done. Here now to discuss, Ryan Payne, president of Payne Capital Management, Hal Lambert, founder of Point Bridge Capital, and Steve Dudash, president of IHT Wealth Management. Hey, Hal, let me start with you. President Trump really, listen, he's upset. I think every president gets upset when the Federal Reserve goes against them and, could derail their economies. We even saw once where Federal Reserve might have even cost a president an election. Having said that, though, is that your only concern? Because I really think right now the only thing that can stop this juggernaut of the stock market is the Fed.
I think you're right. I mean, this booming Trump economy is something that, Facebook and Twitter just can't censor, can they? They can't censor people's 401k plans. They can't censor their IRA statements. They can't talk it down. So, sure, President Trump is concerned about the Fed being over anxious on these Fed rate hikes, and he should be. Look, he's not going to let what happened to George H.W. Bush, what Greenspan did to him. And he threw us into a recession. George H.W. Bush's approval ratings were 90% in January of election year, and he lost the election because we went into a recession. So we're 20. The problem is he's looking at the 2 and the 10-year spread. It's about 25 basis points. So why would the Fed continue to raise rates? And people are projecting another 1% next year on top of 50 basis points more this year. That's going to put an inverted yield curve, and we know what happens then. So, of course, he's concerned about it.
Okay, Steve, there's no doubt that that all these Fed chairmen understand history. They're very loath not to interfere, particularly if there's political implications. But by the same token, President Trump can take it as a compliment that the Fed has to do something to sort of temper this runaway economy.
Right. Well, exactly, Charles. And to the last guest's point, when are you going to raise rates? I mean, right now we're at really low unemployment. Markets are doing really well. Economy's doing really well. When is the perfect time to raise rates, if not now? I'm not saying I want higher rates. I hate higher rates. We all do. Anyone who owns a business or is part of it, it drags on the economy. But at some point, you're going to need to reload that gun for when the next problem comes and we have some ammunition to take care of it, or at least cushion the blow a little bit. So if you're not going to raise it now, my humble question would be, when do you do it? Because I don't think there's a better chance.
Right.
Yeah, no, I agree. I think you're going to have to raise rates just because I think the bigger issue is going to be inflation. And we haven't seen a lot yet, but it's definitely starting to kick in. And anecdotally, I mean, every business owner I talk to.
What about folks who are saying that the Fed is taking action now so that they have ammunition later on? I mean, I don't like that. I mean, if that's what they're going to do, listen, Janet Yellen, when she raised rates the first time, I thought she was trying to send a message to Wall Street. You guys can't kick me around. Yeah. Well, guess what? The market collapsed into January of that year. The first 2 weeks of January were the worst ever in history for a January market. She learned her lesson pretty quickly. So if the Fed does do it for the wrong reasons, whether it's to have some more arrows in their quiver, or any sort of, but Powell isn't your classically trained economist, right? He is a Wall Street guy. He's got to know this.
He's got to know that, but I think they're looking very closely at the inflation data. That's been the story the whole way through, and I think they see inflation, they're going to raise rates.
There's not inflation.
It's starting to creep in. Wages are starting to go up. It's starting to happen. It's all coming. Yeah.
There's signs of inflation.
Go ahead, Hal.
I'm sorry.
Look, they're saying there's signs of inflation. We've got to get ahead of it. There's not signs of inflation. It's 2.4%. Yes, potentially there's going to be a hike in raises to the employees, but that can be offset by productivity. So until the bond market's pretty smart. There's trillions of dollars going into the bond market, and the 10-year is sitting at around 285. So that's telling you something right there, and they're not worried about inflation.
I didn't want to spend the whole segment on the Fed, but I will ask you this, Steve. Earlier this year, the January job number came out on February 2nd. The Dow was off 666 points because the median wage hike was 2.9%. When Main Street hears that Wall Street doesn't want them to even have a 3% raise, they get crazy. I mean, this is the same group that got the $3.5 trillion in phantom money printed up, $1 trillion bailout. The government looked the other way while they did all of these nasty things to Main Street. And now the Fed would like to derail or slow the economy because Main Street may get a 3% raise?
No, it's not about them having a 3% raise. And I'll be honest with you, when the markets went down, and I think I was on your show about that time, we were telling people to buy into that dip because that was an artificial thing that people were overreacting to completely. So that's when you take advantage of emotions getting ahead of themselves. But the fact of the matter is, energy prices are higher, wages are going up slowly, but they are starting to go up right now. And I know no one wants to hear me say this, but the reality of tariffs, they do drive up pricing to some degree. I'm taking the politics out of this, just the math behind it. Tariffs are going to be a little bit higher, so therefore inflation is going to be a little bit higher. Yes, productivity is going through the roof. Yes, we are probably going to be able to grow our way out of some of this. But it is a little naive to say there's no inflation going on right now.
Well, let's talk about this.
Let's talk about the whole point.
Yeah, because this economy.
No, I'm sorry, Charles.
Let's bring politics into it for a moment, guys. Because listen, ultimately, in my mind, this economy is going to be hard to ignore. I know the media doesn't talk about it a lot, particularly maybe this week if the stock market hits new highs. We'll talk about it, in a few things. Maybe it might even make a few headlines. But one thing that caught my attention today, and I'll start with you on this, Ryan. Real Clear Politics. The right direction, wrong track. Right direction is at 40.5%. It sounds low, right? That's the highest level since December of 2012. And what it says to me is that people are begrudgingly starting to allow themselves to believe again. But it also suggests a lot of room to the upside.
Yeah, no, absolutely. I mean, there's so much evidence that we've got a lot of room to the upside. I mean, looking at the market specifically, is you just have to look at valuation. The market's at almost a record high right now, and valuations are cheaper than they were at the beginning of the year. So I have to think there's a lot of room to move in the economy and in the market as well.
Hal, on Friday, Deere reported they have a lot of exposure overseas into China. The stock was initially off 5 points, came back 5. This morning, Estee Lauder reported sales in America only up 2%, their largest, more mature market. Europe is a juggernaut for them. Asia Pacific up like 30%. So it suggests to me that although tariffs are making these headlines, I don't know that it's having an impact to the sense that, hey, the folks in China are boycotting Estee Lauder products.
Yeah, no, it's very interesting. In fact, the earnings overseas have been better than the earnings in the U.S. for these international companies. And earnings are up almost 25% for the quarter year over year. So it's been an amazing earnings run. Revenues are up. We've had 79% of companies beat earnings estimates, and 72% have beat on revenues. So it's definitely booming, and it's booming. But what's also interesting is, as we talk about tariffs, the dollar's rallied. So it's actually brought down pricing overseas because the cost in dollars is less.
How? I'm sorry, Steve?
I don't know if that's the reason why the dollar's rallied. I think you might be connecting different dots there a little bit.
Are you concerned about the dollar getting too strong, though, Steve?
I didn't say it was the reason.
Steve, are you worried about the dollar getting too strong?
No, not right now. There's no indication that the dollar's going to take off anytime soon. And there wouldn't be, let's be honest, where rates are at right now, even if the dollar did try to take off, it would pull it back at that point. So I'm not worried about that. And you guys are spot on. The economy is doing very, very well. Earnings are definitely up year over year. So we should be celebrating like this, where you started the segment with saying we are at the longest bull market, or soon to be the longest bull market in ever. We should be proud of this and happy of all the pieces that have led us to this point, and should not be afraid of continuing to buy into this cycle. I know we're at highs, but this is not like a 2000 high or a 2007 or 8 high where the math behind it didn't justify it at all. This is a justifiable high that you can see continue to go.
You know what? Let's leave it right there. We hit the kumbaya moment. We all agree this bad boy is going to go a lot higher, even if we disagree on why.
No matter what.
All right, guys. Thank you all very much. Appreciate it.